In the middle of the week, Nand called Nilkanth and asked if he was free that evening. Nilkanth replied, "Meet me at the cafe near my home." That evening, Nand reached the cafe a little early. He ordered 2 cups of coffee and waited for Nilkanth. After about 10 minutes, Nilkanth arrived and asked, "Nand, has anything important come up?" Nand replied, "Yes, sir. I recently received a bonus from my company. I don't need this money for the next 3 months. After that, I am planning to buy a bike because I am currently traveling to office through shared conveyance." Nilkanth listened carefully and asked, "Since you need the money after 3 months, have you thought of putting it in a short-term fixed deposit?" Nand nodded and said, "Sir, I already have some FDs with the bank, but someone in my office suggested some short-term financial instruments, like treasury bills, T-bills, commercial papers, CPs, certificates of deposit, CDs, and short-term government securities. That is why I wanted to understand whether they are good options for parking money for a short period." Nilkanth smiled and took a sip of his coffee. "That's a very good question, Nand," he said. "Most people only know about savings accounts and fixed deposits. But once you start understanding money markets and short-term financial instruments, you realize that there are several options available for managing surplus funds efficiently." Nand looked curious. "Money markets?" Nilkanth nodded. "Yes, these instruments are part of the money market, where governments, banks, companies, and large institutions borrow or lend money for short durations, sometimes for just a few days, weeks, or months." He then began explaining each instrument one by one. Treasury bills. First, treasury bills, commonly called T-bills, are short-term securities issued by the government of India to meet its temporary funding requirements. Since they are backed by the government, they are considered one of the safest investment options. They usually come with maturities of 14 days, 91 days, 182 days, or 364 days. Nand interrupted and asked, "Do they pay regular interest like fixed deposits?" Nilkanth smiled. "Not exactly. T-bills are issued at a discount and redeemed at face value. For example, you may buy a T-bill for 98,000 rupees and receive 100,000 rupees at maturity. The difference becomes your return. This is why they are called zero coupon interest rates, means issued at less than face value and redeemed at face value. Banks, mutual funds, insurance companies, and even individual investors can invest in them. Since they carry sovereign backing, the risk of default is extremely low. T-bills are commonly used for short-term parking of funds because they offer high safety and relatively better returns than keeping large idle money in a savings account." Nilkanth further explained, "Nand, treasury bills also have certain minimum investment requirements." He continued, "As per the regulations of Reserve Bank of India, an individual generally needs to invest a minimum amount of 25,000 rupees to purchase treasury bills directly." Nand asked, "Can someone invest more than that?" "Of course," Nilkanth replied. "But any additional investment must usually be made in multiples of 25,000 rupees. Nand then asked, "Sir, what if someone needs money before the treasury bill matures? Can it be surrendered like a fixed deposit?" Nilkanth smiled and replied, "Treasury bills do not have a, quote, premature withdrawal facility like bank fixed deposits. However, they can usually be sold in the secondary market before maturity. Investors can sell them to another buyer through the market if they need funds urgently." Nand looked curious. "Does that mean the investor always gets the full amount?" "Not necessarily," Nilkanth replied. "The selling price depends on market conditions, such as interest rates and demand at that time. You may receive slightly more or slightly less than your expected return if you sell before maturity." Nilkanth continued, "Nand, another important aspect of treasury bills is their taxation." He explained, "Any short-term capital gain, STCG, earned from treasury bills is generally taxed according to the investor's applicable income tax slab rate." Nand asked, "So the profit gets added to the person's income?" "Yes," Nilkanth replied. "For example, if someone falls under the 5%, 20%, or 30% tax slab, the gains are usually taxed accordingly." He then added, "However, one major advantage of these government securities issued by Government of India is that retail investors generally do not face tax deducted at source, TDS, at the time of redemption." Nand looked relieved. "That sounds convenient." "It definitely is," Nilkanth said. "Because when TDS is deducted, investors whose income falls below the taxable limit often have to file income tax returns just to claim refunds. In treasury bills, this hassle is largely avoided since no TDS is deducted upon redemption for retail investors." Nilkanth added, "We will discuss the taxation aspect in detail when we cover individual taxation." Nand nodded thoughtfully. Commercial papers. Nand then asked, "Sir, you explained treasury bills very clearly, but what exactly are commercial papers?" Nilkanth smiled and replied, "Commercial papers, commonly called CPs, are short-term borrowing instruments issued by companies when they need money for temporary business requirements, such as working capital, salary payments, inventory purchases, or operational expenses. He continued, instead of taking a short-term loan from a bank, financially strong companies sometimes borrow directly from investors by issuing commercial papers. Nand asked curiously, "Who can issue them?" Nilkanth replied, "Only companies with strong financial standing and good credit ratings are generally allowed to issue commercial papers. Since these are unsecured instruments, investors mainly rely on the company's financial strength and creditworthiness." He further explained, "Commercial papers are short-term debt instruments. They are usually issued for periods ranging from a few days up to 1 year. They are generally issued at a discount and redeemed at face value, similar to treasury bills. They normally offer higher returns than government-backed instruments, because they carry comparatively higher risk." Nand then asked, "Sir, what is the minimum investment required in commercial papers?" Nilkanth replied, "Commercial papers are generally meant for large investors and institutions. As per the guidelines of Reserve Bank of India, the minimum investment in a commercial paper is usually 5 lakh rupees. Nand looked surprised. That means small retail investors may find it difficult to invest directly. Exactly, Nilkanth said. That is one of the reasons why many retail investors indirectly participate through liquid mutual funds and other debt mutual funds, where the fund manager invests pooled money into instruments like commercial papers, treasury bills, and certificates of deposit. He further added, since commercial papers carry slightly higher risk compared to government securities, they generally offer comparatively better returns to compensate investors for that additional risk. Nand immediately asked, why are they riskier than treasury bills? Nilkanth answered, because treasury bills are backed by Government of India, whereas commercial papers depend on the financial health of private companies. If a company faces financial trouble, repayment risk increases. He then added, that is why investors should always check the credit rating and reputation of the company before investing in commercial papers. Nand then asked, Sir, can commercial papers also be surrendered before maturity like treasury bills? Nilkanth replied, commercial papers generally do not have a premature withdrawal facility like bank fixed deposits. However, since they are tradable instruments, they can usually be sold in the secondary market before maturity. Certificates of deposits. Nand then asked, Sir, you also mentioned certificates of deposit. What exactly are they? Nilkanth replied, certificates of deposit, commonly called CDs, are short-term financial instruments issued by banks and certain financial institutions to raise money for a specific period. He continued, in simple words, they are somewhat similar to fixed deposits, but they are issued in a tradable form and are mainly used in the money market. Nand asked, so are they safer than commercial papers? Yes, Nilkanth replied. Generally, certificates of deposit are considered relatively safer than commercial papers because they are issued by banks and regulated financial institutions, whereas commercial papers are issued by companies. He further explained, certificates of deposit are short-term debt instruments. They are issued at a discount or may carry a fixed return. They usually have maturities ranging from a few months to 1 year for banks. Since they are tradable, investors can generally sell them in the secondary market before maturity if required. Nand then asked, who usually invests in them? Nilkanth answered, mostly institutions, corporates, mutual funds, and high net worth investors participate directly. Retail investors usually gain exposure indirectly through debt or liquid mutual funds. He then added, certificates of deposit generally offer slightly better returns than savings accounts or very short-term deposits because the investor agrees to lock the money for a fixed period. Nand then asked, Sir, what is the minimum investment required in a certificate of deposit? Nilkanth replied, as per the guidelines of Reserve Bank of India, the minimum investment in a certificate of deposit is generally 5 lakh rupees. Nand looked surprised again. That means even CDs are mainly meant for large investors? Exactly, Nilkanth said. Short-term government securities. Nand then asked, Sir, you also mentioned short-term government securities. Are they different from treasury bills? Nilkanth smiled and replied, treasury bills themselves are one type of short-term government security, but the term short-term government securities is broader and generally refers to government-backed debt instruments issued for shorter durations. He continued, these securities are issued by Government of India to manage short-term borrowing requirements and maintain liquidity in the financial system. Nand looked slightly confused and asked, Sir, then what is the actual difference between short-term government securities and treasury bills? They sound almost the same. Nand then asked, Sir, what is the minimum investment required in short-term government securities? Nilkanth replied, The minimum investment depends on the specific type of government security. For many government securities made available to retail investors through platforms regulated by Reserve Bank of India, the minimum investment can start from as low as 10,000 rupees. Nand looked surprised. That is much lower compared to commercial papers and certificates of deposit. Exactly, Nilkanth said. That is one reason why the government has been encouraging retail participation in government securities. Nand paused for a moment and then asked, "Sir, should I invest in treasury bills?" Nilkanth smiled and replied, "That depends on your objective, investment amount, and how comfortable you are with managing these instruments directly." He continued, "You mentioned that you need the money after around 3 months for purchasing a bike. Treasury bills can be suitable for short-term parking of funds because they are backed by the government of India and are considered very safe." Nand then asked, "Sir, if someone wants to invest in treasury bills, how can they actually do it?" Nilkanth smiled and replied, "There are mainly 2 ways to invest in treasury bills issued by government of India, directly or indirectly." He began explaining the direct method first. Direct investment in treasury bills. An investor can directly buy treasury bills through platforms regulated by Reserve Bank of India, such as the Retail Direct platform, or through certain banks and brokers connected to government securities markets. He further explained the general process. Open a Retail Direct account or use a participating bank/broker platform. Participate in government security auctions or buy from the secondary market. Invest a required minimum amount. Hold the treasury bill till maturity or sell it in the secondary market if funds are needed earlier. Nand asked, "What happens after maturity?" Nilkanth replied, "On maturity, the face value amount is credited to the investor's linked bank account." Indirect investment through mutual funds. Nilkanth then continued, "The second and more common method for retail investors is through liquid mutual funds or debt mutual funds. These mutual funds pool money from many investors and invest in instruments such as treasury bills, commercial papers, certificates of deposit, short-term government securities." Nand then asked, "So what would you suggest for someone like me?" Nilkanth replied, "For a beginner who wants safety, liquidity, and simplicity for a short duration like 3 months, even a liquid mutual fund can be worth understanding because it indirectly invests in treasury bills, commercial papers, certificates of deposit, and other short-term instruments." Nilkanth smiled and said, "Remember this, Nand. Good investing begins with understanding, not excitement." He continued, "Many people invest simply because their friends, colleagues, social media influencers, or relatives suggest something. But investing without understanding is like driving on an unknown road without a map." Nand nodded silently. Nilkanth added, "Before investing in any product, always ask yourself a few basic questions. What exactly is this instrument? Who is issuing it? How does it generate returns? What risks are involved? When will I get my money back? What happens if I need money earlier? Is this investment suitable for my goal and time horizon?" He then smiled and said, "Excitement may help you start investing, but only understanding helps you stay invested wisely." After sitting quietly for a few more minutes and finishing their coffee, both Nand and Nilkanth stood up from their seats. Nand thanked Nilkanth and said, "Sir, today I understood that short-term investing is not only about returns, but also about safety, liquidity, and understanding the instrument properly." Nilkanth smiled and replied, "Exactly, Nand. Every investment has a purpose. The right investment is the one that matches your goal, time horizon, and risk-taking ability." As they stepped out of the cafe, the cool evening breeze filled the streets. Nand left towards his home, thinking deeply about everything he had learned that evening, while Nilkanth walked back towards his house with a calm smile on his face.